Buying a home on a single income starts with choosing a payment that protects your life, not chasing the largest loan a lender will approve. A single paycheck creates concentration risk, because a job interruption can affect the entire housing budget. Imagine earning $90,000 and receiving approval for a home that produces a $2,700 monthly payment. On paper, the ratios may work. In real life, that payment could crowd out retirement contributions, travel, repairs, and career flexibility. A safer target comes from your actual spending, savings goals, and tolerance for uncertainty. Review at least 6 months of bank and credit card statements, then calculate what remains after taxes, essentials, debt payments, and automatic investing. The right home price is the one that leaves breathing room every month. Affordability is not about proving that you can make the payment today. It is about ensuring the payment still works when life becomes expensive tomorrow. The approval from a lender should be treated as a financing limit, not a spending recommendation. Lenders focus heavily on gross income, credit, assets, and your debt-to-income ratio, often called DTI. That calculation does not fully understand groceries, childcare, medical needs, or how aggressively you want to fund a 401k. Suppose your gross monthly income is $8,000 and your recurring debt payments are $700. A proposed housing payment of $2,300 would bring total monthly debt to $3,000, creating a DTI of 37.5%. That might qualify, but qualification says nothing about whether the remaining cash supports your priorities after taxes. Ask the lender for the complete monthly payment, including principal, interest, property taxes, homeowner's insurance, mortgage insurance, and any HOA dues. Then compare that figure with your net income, not merely your gross income. Approval math determines what you can borrow, while personal cash flow determines what you can comfortably own. A monthly rehearsal is one of the best ways to determine whether a single income home budget is truly sustainable. Before making offers, live with the expected cost for 3 to 6 months and save the difference automatically. This test exposes expenses that a spreadsheet can miss, while building additional cash for closing. If your rent is $1,600 and the projected mortgage, taxes, insurance, and HOA dues total $2,400, transfer at least $800 into savings each month. Add another $300 for maintenance, if the property is likely to require roughly that amount over time. You are now testing a $1,100 increase instead of pretending the mortgage is the only change. If the transfers force you to use credit cards or pause retirement savings, lower the target price before becoming contractually committed. If the test feels manageable, you gain confidence and a larger reserve. A successful payment rehearsal turns affordability from an estimate into evidence. A larger down payment can reduce your mortgage, but preserving liquidity may be more important than reaching 20%. Home equity cannot pay a surprise bill without a sale, refinance, or loan. Cash can. Consider a $350,000 home. Increasing the down payment from 10% to 20% requires another $35,000 before closing costs and moving expenses. That additional cash may lower the payment and remove private mortgage insurance, but it could also leave only $8,000 in the bank. For a buyer relying on a single income, that reserve may disappear after a furnace replacement and a short period without work. Ask for side-by-side loan estimates at several down payment levels, including the interest rate, mortgage insurance, cash required at closing, and total monthly payment. Then choose the option that balances lower borrowing with adequate reserves. The strongest down payment is not automatically the largest one. It is the amount that improves the loan without making the rest of your finances fragile. A single-income homeowner needs a layered safety net before receiving the keys. A single paycheck supports the mortgage, so a job loss, illness, or major repair can create pressure faster than it would in a household with 2 incomes. Start with 6 to 12 months of essential expenses, based on the budget you will have after buying. If housing and other necessities total $4,500 per month, a 9-month reserve is $40,500. keep that money accessible in a high-yield savings account, separate from the cash for closing. Add a dedicated home repair fund, because an emergency fund should not be repeatedly emptied by predictable ownership costs. Also review health, disability, and term life insurance, especially if anyone else depends on your income. Insurance does not replace savings, but it protects against risks too large for savings to absorb. A layered reserve gives you time and options, which are the most valuable assets when a single income carries the house. Strengthening your financial profile before applying can improve both approval odds and long-term affordability. Mortgage pricing rewards lower risk, and even a modest rate difference can affect a single income budget for years. Focus first on debts with large required monthly payments, then protect your credit history. For example, using $8,000 to eliminate a car loan with a $450 monthly payment may improve cash flow and DTI more than adding the same $8,000 to a down payment. Pay every account on time, reduce revolving credit balances, and avoid financing furniture or a vehicle before closing. Do not close an older credit card merely because its balance reaches $0, since account age and available credit can influence your score. Review credit reports from all three bureaus early enough to dispute genuine errors, and ask lenders how different credit scores affect the quoted APR. Better borrower fundamentals can produce a lower payment, while less mandatory debt creates room for repairs, savings, and normal life. The property itself should reduce financial stress, not simply fit the maximum purchase price. On a single income, predictable operating costs are often more valuable than extra square footage or a dramatic renovation opportunity. Compare homes by total ownership burden, including taxes, insurance, utilities, commuting, maintenance, and near-term replacements. A $320,000 townhouse with a healthy HOA may cost less overall than a $300,000 detached home that needs a roof, windows, and 25 miles of additional commuting each day. The cheaper listing can become the more expensive life. Study property tax history, insurance availability, HOA financial statements, reserve funding, and major building projects. During the inspection, ask about the age and condition of the roof, HVAC system, plumbing, electrical service, drainage, and appliances. Use those findings to estimate the next 5 years, not just the initial month. The best single-income home is usually the property with costs you can understand, forecast, and absorb. Mortgage shopping should compare complete loan structures, not just advertised interest rates. Fees, points, mortgage insurance, and rate type determine the real cost, while predictable payments have extra value when a single income carries the obligation. Request official loan estimates from at least 3 lenders on the same day, using the same price, down payment, and lock period. For a 30-year mortgage of $300,000, a rate difference of 0.5% can change principal and interest by roughly $100 per month, depending on the rates compared. Discount points may lower the payment, but calculate how many months of savings are needed to recover the upfront cost. A fixed-rate mortgage usually offers clearer budgeting than an ARM, although every option should be judged against your expected ownership period and risk tolerance. Also investigate legitimate assistance programs for new homebuyers, then read their income limits, occupancy rules, and repayment terms. Careful comparison creates a payment you understand and can plan around. Your final offer should preserve financial safeguards and leave room for the costs that begin after closing. A competitive market can encourage buyers to waive inspections, cover appraisal gaps, or spend every available dollar. But a single income provides less capacity to recover from a bad surprise. Suppose you buy a $360,000 home and set aside 1% of its value each year for maintenance. That is $3,600 annually, or $300 per month, before any major known project. Your property may need more or less, but the exercise forces maintenance into the budget. Keep inspection, financing, and appraisal protections whenever the market and professional advice allow. Review the closing disclosure carefully, confirm the cash required, and avoid transferring funds until wire instructions are independently verified. After closing, automate monthly deposits for repairs and annual bills, and expect taxes and insurance to rise. A disciplined offer allows you to own the home without letting the transaction destabilize everything else. Buying a home on a single income is achievable when the entire plan is designed for resilience. The winning strategy is not a clever mortgage trick because the risk comes from several places at once. Set the price from net cash flow, rehearse the payment, preserve cash after closing, reduce mandatory debt, compare lenders, and choose a property with understandable costs. A buyer approved for $400,000 might choose a $340,000 home, keep a 9-month reserve, and automate $300 per month for maintenance. That buyer has not failed to maximize purchasing power. That buyer has purchased flexibility, including the ability to handle a repair, continue investing, or survive a career transition without immediately threatening the home. Your goal is not merely to reach closing day. Your goal is to remain financially secure through every year that follows. If this framework helped you define a safer path to homeownership, like this video and subscribe. In the comments, share which part of your plan you are working on first.